Welcome to Catalyst. I'm Seana Smith alongside Madison Mill. 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down today's market action as the S&P 500 rebounds from those 4 days of declines. Where can investors find safety?
Plus, we push ahead to the all-important earnings after the bell as we await NVIDIA results. We've got full coverage for you ahead.
And we hone in on Washington amid Doge's efforts to cut federal spending. What could that mean for tax season? We'll discuss with the former commissioner of the IRS.
About 30 minutes into the U.S. trading day, you are seeing a bit of a recovery playing out following 4 down days for the S&P 500. We certainly saw risk-off sentiment creeping into the market following some of that weakening econ data that we have been getting out, particularly on the sentiment side of things over the last several trading sessions. Now, ahead of NVIDIA's results after the bell tonight, we are seeing some buying action. You do have the S&P up just about 0.6%, the NASDAQ leading the way up just about 0.9%. And Maddie, when you take a look at the gains that we're seeing in the NASDAQ today, I think that's obviously going to be a focus, just given one of the things that I know that you've been watching, this lost momentum out of the momentum trade, and whether or not NVIDIA results are going to be enough to help regain some of that lost confidence that we have seen.
Especially given that DeepSeek sell-off we keep talking about that led to a $600 billion loss in NVIDIA's market cap. I think this is interesting, a chart I'm looking at on the terminal right now showing that mega cap U.S. tech stocks are the most under-owned when you take a look at active investors, but it seems like they just can't shake this trend of going back to their tech X here, because every time we get a little bit of a sell-off, you then see a day like today. 4 days of selling, we're making such a big deal out of it, but in the context of the market, that's really just not that big of a deal.
Yeah, that's true. Well, we're not used to it.
Right.
Because we're used to so much optimism being in the market. We're used to some of these, I would say just optimism across the board. And now we are starting to see maybe the markets take a different view more broadly of the U.S. economy, be a little bit more critical about some of the reports that we have gotten out, which hasn't necessarily been the trend over the last several months.
Yeah, and we certainly are at a minimum seeing a shift in the market underway. When you take a look at factor trading, seeing investors move from the momentum trade into areas like value. So could NVIDIA results change or cement the rotation? Joining us now with more, we've got Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. Jeff, great to chat with you. Talk to me about the momentum trade sort of stalling out as investors shift over from growth to value. How cemented is that trade in your view?
I don't think it's extremely cemented. And I think also for context, it's interesting when you say that the mega cap tech stocks are the most underowned. You have to keep in mind that they now represent some of those holdings in the S&P 500, which has become so uber concentrated. They represent 7, 8, 9% position sizes. And so, back when I started in this industry 40 years ago, if a single holding in a diversified portfolio was in excess of 5%, you were considered reckless. So they're still heavily owned and they represent more than a third of the S&P 500. I think it's probably smart to under-own them relative to the index. That's part of, active management. But to answer your question, we have noticed that if you look at what is working so far this year, because of all of the violent pace of news flow, whether it's tariffs or deportation strategies or, government shutdown or whatever it is, it's spooking people. And if you look at the charts, it's healthcare, staples, these defensive areas that you're seeing rotation into and that are outperforming. And after lagging for some time, I think that could be sustainable, but I think it's premature. We are ever so gingerly taking the foot off the pedal just a little bit and recognizing that some of these defensive stocks represent very good value. And you might want to nibble just a little bit.
Jeff, I guess for investors that are trying to figure out whether or not that some of the buying action that we have seen in those that have underperformed, the more defensive plays, whether or not there's more room to run within that sector. I guess more specifically, what are you looking at in order to determine that we could see more broadening and we could see more activity within, is it a continuation almost of some of that weaker econ data that we have started to see?
Well, it's a combination of the top down and the bottom up. The bottom up's going to be there. I'm not just going to make some kind of shift into the defensive's cause. The earnings have to be there. Valuation certainly is there. And I think that if we continue to see strength and breakouts in some of these weaker names technically, that gets your attention. And then as you see flows start to develop in those areas, that's saying sentiment, has kind of shifted. So I think we just got to see a sustained period. And you're right. I mean, tonight is data. If NVIDIA comes out and the earnings news kind of reinstills confidence, then, I think that we will see a more balanced, broader participation this year. We expect the market to be up 10%, and both camps could do well. I think it just depends on what the news flow is out of areas like NVIDIA and the Mag 7. As long as the news is not devastating, they can still do well. And as long as the economy holds up and earnings in these other areas, they're very attractively priced. And I think you could just see a broadening in the market with some of these other stocks playing catch up. But it's a day-to-day kind of observation on what's going on.
So you mentioned your price target of 6,600 by year end, implying about a 10% move. And I hear you saying that there is still a bit of optimism to be squeezed out of the tech trade, but what gets us that 10% move to the upside? Again, you're saying this broadening, but you still like tech. What exactly does that 10% move to the upside look like, and how do you position to take advantage of that?
Well, first of all, it's a function of PE multiples and earnings, right? That's how you get to 6,600. So if you apply a 21.5 multiple to our expected earnings that you'll see as we move into 26 of a little north of 300, that's how you get 6,600. And then you have to go underneath the hood and see, well, how are you getting that earnings growth? And quite frankly, right now, consensus earnings, when you look broadly across sectors, not just technology, but it's healthcare, consumer discretionary, finance, earnings growth looks good. So, you can argue about positioning, but when you just look at the aggregate index level, there's earnings support there. And it's predicated on about 2.5% earnings growth. The 10-year Treasury trading around 4.5%. And solid margins that hold up. And right now, there's no reason to think that that's not going to happen. And we may get wiggy day to day about the recent headlines on news coming out of the administration or speculation about what the Fed may do. But underneath the hood, you've got solid earnings growth broadly. And that's what you got to continue to track and see if we stay on course. And there is risk when you're trading at 21, 22 times. If profit margins stall, then you're going to get some hiccups. But right now, that's how you get to 6,600.
All right, Jeff, we have to leave it there. Jeff, we have to leave it there. Thanks so much for taking the time to join us here this morning. I want to get to some trending tickers at Yahoo Finance. You scan the QR code below to track the best and worst performing stocks of the session. That's the Yahoo Finance's trending tickers page. There's a slew of auto news out today, from Lucid to GM to Stellantis, plus to some of the overhang here, potential tariffs that continue to loom across the industry. Here to cover it all is our very own Pras Subramanian. And Pras, we were discussing where to start just because there's so many headlines driving a lot of the action here today. But let's stick with Lucid, just given some of the activity that we are seeing in the stock here so early. Shares falling as the company launches a search for a new permanent CEO. And this comes following the unexpected departure of its long-term CEO, Peter Rawlinson. When it comes to some of the concern that's maybe playing out within the industry, I guess, what are investors most concerned about when it comes to the new potential CEO?
A big mix here, right? So last night we got the news that Rawlinson was stepping down. I was pretty surprised, and no one saw that sort of coming. He was there for 12 years, sort of brought the company to where it is today. I think the issue potentially maybe for investors and the big investor, which is the Saudi PIF, was that maybe they were just the company wasn't cutting costs enough as it drove growth, and it's sort of launching its new Gravity SUV. But we'll have to see. Rawlinson is going to stick around as a strategic technical advisor to the chair. The current COO, Mark Winterhoff, is going to be the new interim CEO for the time being while they do their search. But yeah, it seems like Rawlinson sort of brought the company to where it is, but the next level, the next phase, the ownership management probably wanted a more efficient operator there to kind of get the company back into, or get the company into the green at some point, or at least have a path for that. One bright spot is that they do see deliveries doubling this year to 20,000 vehicles because that new SUV that's coming out in the next few months.
Well, Praz, it's also a share buyback season, and we have some news from GM with shares moving to the upside as it's looking to boost its quarterly dividend, and also has some news of share buybacks and a repurchasing plan. What can you tell us?
Yeah, GM a few weeks ago disappointed investors by not announcing a buyback plan or a capital return plan, but now they have decided to do so a few weeks later. They're going to get basically a hike in the dividend of 3 cents per quarter, so up to 15, I believe. But more importantly, it's that $6 billion share repurchase plan that includes a $2 billion ASR or accelerated share purchase plan that happens right away, and the balance of which can happen over time, that $4 billion. But regardless, GM shares are getting popular, investors getting that capital they want returned back to them. We'll see how that plays out. CFO Paul Jacobson said that they would prudently manage their situation and announce these buybacks. And last year, you had a huge run up in the stock because of these share purchase plans.
And also, Stellantis shares are sliding after issuing guidance that fell short of analyst expectations. And this comes after, as you know, they had a tough year last year and said they do expect to return to revenue growth and positive cash flow this year. What else can you tell us?
Last year, Stellantis said that they saw 2024 being a potential turbulent year. I don't think they had any idea of how bad it would be. They lost their CEO. They saw sales sort of crater in the U.S., ballooning inventories. That sort of leads to where we are today. Full year revenue down 17% from a year ago. Full year profit down 70% from a year ago to 5.5 billion euros or 5.8 billion US dollars, well below analyst estimates. They do see a return to revenue growth next year. They had deeply negative industrial cash flow. They see that returning to the positive, but it's going to be slow steps, small steps for them to kind of to recreate what they had in 2023, which is a blowout year. It's kind of surprising to many people to see how they lost that momentum so much into last year, whereas GM and Ford doing better than they are, but still, we're talking about an industry that's sort of in the focus here with Trump talking about tariffs. A lot of these guys are trying to prepare themselves for how do I fulfill my supplier commitments? How do I get my parts, my cars back and forth across the Mexican-Canadian border? That's another big overhang for all these three companies right now.
President, I want to talk to you a little bit more about tariffs because President Trump posted on Truth Social this morning very critical of something that was published by the Journal, and he basically said that he views tariffs, that they're going to be a big win for the industry. He said, quote, just let it all happen. Obviously, that contradicts some of the research and some of the modeling coming out from analysts just in terms of the impact that this could have on especially the big three automakers, and then ultimately maybe some of the costs that could be passed on to consumers as a result.
Yeah, I think Trump is not only reacting to criticism on the left, but the criticism on the right. This is the Wall Street Journal editorial page saying that these tariffs are just a bad idea. I think he's just sort of frustrated with those comments because he wants them to be on board with this policy, which is sort of a continuation from his previous term. But as you know, as we talk about, a lot of these companies, especially the auto companies, are interconnected with suppliers and assembly plants that are across borders. This is a big problem for them, and I think Trump is trying to address the criticism on both sides to get his at least his side on his economic policy projections here. But that is a big problem right now for the auto companies and a number of other multinational companies, is that the fact that they have to somehow navigate a world where tariffs can happen at any time. And right now, it's just like sort of there's a sort of Damocles hanging over these companies. When is it going to hit? He's saying, let it all happen. What does that even mean? So that's where we are right now with these big companies.
All right, Praz, thanks so much for joining us and breaking down all the news in the auto sector for us today. Appreciate it.
Thank you.
Next up, AB InBev shares jumping on better than expected revenue in its fourth quarter, offsetting a decline in volumes. Here to explain, we've got our very own Brooke DePalma. And Brooke, it's so interesting because that global sales volume was significantly down, but then we see a move to the upside. What's the takeaway from AB InBev's earnings?
Right, well, investors certainly saying a toast this morning because we did see a beat on both the top and bottom line. But taking a closer look, revenue growth really was driven by a few key factors. When I spoke to the CFO of the company this morning on a phone call, he said that growth, that 2.7% increase in total revenue to $14.84 billion was largely driven by the execution of their strategy as well as volume growth in keyword most of their markets. So that strategy that they're really pursuing here is focusing on this idea, this concept of mega brands. So focusing in on roughly 5 brands per market, and that's what drove more than half of total revenue this past quarter. Now, if you take a closer look at volume, we did see a decline of 1.9% year over year in the quarter. Now, that did move lower by 2 key markets. You had mid to high teen negative volume growth in both Argentina as well as China. In China specifically, the CFO alluded that to the softer consumer environment in China, saying that they specifically saw softness within their on-premise occasions like those night outs. Now, if you also take a closer look at what we saw here in the U.S., a bit of good news there. We did see sales to retailers, a key metric that many on the street watch, return to growth. That increased 0.05% after we saw a decline of 12% in that same quarter last year. When I asked how exactly is the U.S. consumer holding up in this environment, the CFO said that the U.S. consumer is in okay shape. He alluded to this dynamic environment in 2024, a colder summer, and then a colder weather to kick off the year. He also said to really get a fair take and a fair understanding of where the U.S. consumer is, we'll be looking to the summer.
And Brooke, we just had a graphic up there talking about tariffs, and I think that is a real focus here for investors as they try to figure out what company is maybe best positioned to be able to look beyond, or I guess weather some of the turmoil that could come.
Yeah, we're hearing a lot of that from one of their closest competitors, Constellation Brands. There's lots of fear on the street that because of Mexican imports potentially being impacted by tariffs, Constellation Brands will lose in this. But Anheuser-Busch saying that's not the case. It's a global beer company, and they really look to beer as a local business. Specifically, the CFO did say most of our beer is sourced, brewed, and consumed locally. So any exposure to tariffs is very limited. Specifically about the U.S., 99% of what we sell in the U.S., we make in the U.S. He went on to say that we source the vast majority of our ingredients and other raw materials also in the U.S., so there would be a very limited, if any, impact. Now, I did go on to ask, what about aluminum prices? We know that that's been top of mind. He said that once again, they're more or less in the same range than what they saw last year, and that they have a hedging policy. They're really hedging against this, but once again, emphasizing that tariffs, if they do go into effect, would be a very limited impact on the Anheuser-Busch company.
All right, shares up just about 8.5%. Brooke, thanks. Well, we got much more of your market action ahead. Stay tuned. You're watching Catalysts.
The big day, NVIDIA earnings after the bell. You can see the shares up nearly 3.5% after fighting a couple of weeks of losses. Year to date, the stock is down nearly 6%, and this comes as those NVIDIA earnings expectations are sky high. Some big questions heading into the report are supply and demand dynamics. Will the company have the supply to meet the demand? That is something that the other big tech names struggled with, particularly Microsoft. Of course, another big question, what are we seeing in terms of transitioning from the Hopper to the Blackwell chip, and then anything that's said about that competition from DeepSeek, we will be monitoring in our special coverage on NVIDIA earnings after the bell. But let's broaden this out to what this means for AI data centers. Meta is reportedly in talks to build a new $200 billion AI-focused data center, according to the information. That report comes days after Apple pledged to invest $500 billion in the U.S. over the next 4 years. Part of that will be used to build out AI infrastructure. Here with his read on data center build out. We've got Anthony Johnson, CEO of Clayco. It's a construction firm specializing in data center construction with clients including Google, Microsoft, and Amazon Web Services. Thank you so much for being here with us, Anthony. I just want to kind of operationalize the demand picture from where you sit. We hear about these big dollar investments from the hyperscalers. What is that looking like right now across your desk, and how much growth have you seen in that demand?
Yeah, thank you. Good morning, and it's a pleasure to be here today. It's just truly an incredibly exciting time in the industry. For one, it's almost like we're part of a modern day space rush or gold rush. And what we've been seeing over the last several years, even prior to the AI push, has been, number one, an extreme growth in cloud computing. You think about the computing required for everything from iPhone usage to companies converting everything to cloud storage. There was already a strong foundation of growth in the data center market. AI has added another layer of exponential growth that we've seen over the last couple of years. And that's resulted in the need for more computing power, more dense builds, which require higher levels of energy and higher levels of mechanical cooling as well. So a lot of new innovation and drive that's happening in the business right now.
Anthony, I'm curious, just given the learnings, the findings that we did hear about just about a month ago when it comes to DeepSeek, has that at all changed? Have you seen at all just a shift from some of the commentary or priorities here from some of your customers?
Not really. I think in any business, as the technology evolves and as more competition is introduced, there's innovation, and innovation is good. Competition is good, and so I think there's new learnings that happen from one entity to another. I think Jensen Hughes did a great job of explaining the various levels of training and inference that are ultimately developed. And DeepSeek was a great introduction and new innovation in the business, but there still is a tremendous amount of training beyond DeepSeek's capabilities that are needed to truly get to a strong inference solution.
I also want to talk about another headwind presented by TD Cowen this week. Analysts saying in a note that in their channel checks, they have evidence that there are data center lease cancellations happening from Microsoft, of course, one of your clients. Have you seen any of that cancellation from Microsoft on data center buildouts?
Not speaking to Microsoft directly, but just speaking about any large business that's undergoing a large CapEx expansion, I think growth is something that is not exactly linear. There are strategies that are implemented. They're modified over time, but in the end, the growth trajectory is still maintained. So we don't really see day-to-day changes in one facility or another affecting an overall outcome or an overall capital spend. In fact, to the contrary, we continue to see extremely strong demand in the market from various users in the space.
Anthony, what's the ability there to meet that demand?
Well, that's where I think, as I spoke earlier, this type of demand and growth drives a lot of innovation to the space. We've innovated ourselves and developed a solution that we've branded as Clayco Compute. And when you look at how these facilities have traditionally been delivered throughout the United States, there's been end user ownership. There's been partnerships with good engineering companies. There's been partnership with great construction companies, but there hasn't really been a one-stop solution. And Clayco Compute, which we launched earlier this year, really brings that engineering capability, the procurement capability, construction, and also self-perform all under one roof for a single source solution for our customers. Speed to market is key. And to not have to bring multiple parties to the table, but rather be able to call one partner to be able to deliver that full integrated solution is what we're doing to differentiate ourselves and really address our customers' biggest need, which is how to get them to the market the fastest.
Yeah, and I guess the good news for you is that your customers continue to ramp up their AI spend, despite what the market might think about that. If we can pull up, we've got a chart indicating just the sheer record-breaking numbers in terms of CapEx from the big tech names here. You've got on your screen Meta expected to spend about $65 billion, and then all the way at the longer end, Amazon expected to spend about $100 billion in AI CapEx, and CapEx in general, rather, in 2025. But that leads to a question and concern about whether the froth is already there. You were able to double your data center revenue from 2023 to 2024. It seems like you're growing, but at a slower clip now. What would you say is driving the deceleration?
I wouldn't say there's any deceleration. Actually, it's really a controlled growth phase for us. Construction's a business to where our reputation's everything, and we have to make sure that every project that we deliver is on time, it's under budget, it's delivered safely. And so when projects of this size and scale are being executed, it's important that we dive through our resources, make sure that we've got the right leaders on the project, that we've got the right resources allocated to certain projects. So certainly no constraints in the market that are holding us back from growing at all. I would say, to the contrary, we're really trying to self-moderate our growth to some extent so that we can ensure that we're continuing to deliver at the high level of excellence that our customers demand.
All right, Anthony, great to have you. Great insight. Thanks so much for taking the time.
Yeah, thank you.
Coming up, we'll hear from Intuit's CFO. He will join us live to discuss the company's second quarter results and what proposed changes under the Trump administration could ultimately mean for the industry. We've got that coming up next on Catalysts. Intuit is surging today following the fact that the company beat expectations for its fiscal second quarter, also reaffirmed its full year outlook. Morgan Stanley upgrading the stock from equal weight to overweight following those results. We want to bring in Sandeep Aujla. He's the CFO of Intuit. And Sandeep, it's great to have you here on Yahoo Finance. So it's a pretty impressive reaction that we're seeing in shares today. We're looking at the biggest intraday jump that we've seen since at least 2021. Talk to us just about the factors going into that improved guidance and what you really see as sustaining some of that momentum clearly that you're seeing within your business.
Well, good morning. Thank you for having me. I couldn't be more proud of the work the team did. We've got excellent momentum across the company executing on our global AI-driven expert platform strategy. The momentum we have across Intuit Assist, our done-for-you experiences with expertise embedded. The momentum we have in mid-market, where we're gaining ground day in, day out, and getting better at executing on that strategy. And finally, a strong start to the tax season. The results we had the first half of the year are positioning us really well to continue to build on this momentum and have a strong year, strong fiscal 2025. And the results in terms of 19% revenue growth overall for the company, and in our 17% overall for the company, 19% of Global Business Solutions Group, our largest business, as well as 21% in online ecosystem, which is a business that is at an $8 billion annualized run rate. Just exceptional execution across the company by the team.
And Sandeep, talk to me about how you're utilizing AI on the platform to drive revenue, because you offer some of that as sort of a given with the fees that are charged to customers for filing via TurboTax. But what parts of agentic AI are you utilizing to drive even more revenue on top of that original fee?
The way we look at AI, it is a core part of the product experience across our platform. So we are taking end-to-end tasks. We're taking entire functions and automating those. In the consumer group, in the tax business, from the moment you land on our website and we get to learn about you in terms of what your profile is, what your tax situation is, we use AI to serve up the right offerings for you. So every person who comes in is not going to see the same lineup. The lineup is using AI to deliver a very bespoke experience. And then once you get into the experience, we now have 90% coverage through 200 partners to bring in the data versus 68% coverage last year. And we now know in 90% on what your tax situation is. And based on that, it's going to be very bespoke experience for you, Maddie, versus for me. And that is AI operating at scale in the consumer business. And some customers may not want to do their taxes themselves, and they may want to use one of our 12,000 AI-powered human experts. And in those situations, we are using AI to match the right expert to that customer and give the customer the profile why we think this is the right expert for them. Mm-hmm. And there we see 82% conversion rate of people taking that expert up. And then we're using all the data to power the expert so they're able to do a tax return in as little as 2 hours. And when we get the tax return done, the customers are giving us an 84 product recommendation score, which is amongst the highest in the company, if not one of the highest across the broader software industry. So across the board, AI is just a core part of how we work, and it's really paying off at scale.
Yeah, that's a huge uptick rate in terms of what you're saying, 80% of users utilizing that AI expert to walk them through their tax filing. Have you all had conversations about charging extra for that expert?
When customers engage with an expert that is a higher priced offering, compared to when they do it themselves. But beyond our consumer group, when you look at our small business, our global business solutions group, where we serve small and mid-sized businesses, what we're seeing is when we're taking unstructured data and turning that into invoices, or turning that into payment reminders, or turning them into automated books done for you experiences, and customers are then using that to remind their end customers to get paid, we're seeing 10% higher payment conversion rate. We're seeing customers take up our agents on the Global Business Solutions Group as well, and we shared that their QuickBooks Live offering, where a customer works with an agent, is up 2.5 times year over year in terms of number of customers we're being served. So these offerings where you're working with an agent come with an order of magnitude higher ARPC than our do-it-yourself offerings.
Sandeep, I'm curious how you're looking at the developments out of Washington, the cuts that are expected and that we're seeing here at the IRS, obviously ahead of the critical tax season, ultimately the impact that could have on your business.
As a company that serves 100 million customers, we engage with the Washington and the administration, regardless of which political party is in power. And our goal with the engagement is always to serve our customers, to make sure that the government policies and regulations are for the best benefit of the consumers, as well as the entrepreneurs who own the small and mid-sized businesses we serve. So in that area, I think our engagement has been quite positive. The changes being made at the IRS right now, we think will not have a negative impact. In fact, a negative impact on the business. In fact, likely a positive impact. What the government is focused on is driving efficiency. They're focused on taking out fraud, and they're focused on making sure that the end customer is having the best tax filing experience and the clarity in terms of what their tax situation is. That's very much in sync with what our goal is also as a company. So I think this is going to be more of a tailwind to us than a headwind.
Sandeep, help me understand that a little bit more. How would that have a positive impact, especially in the context of something that I've been noticing, which is this idea that's going around social media of people not filing their taxes because the president floated an idea of the federal income tax going away? So how do these cuts at the IRS provide a tailwind for the business?
The cuts at the IRS, Maddie, are focused more on the contractors and not the core part of the IRS. Where I mentioned the tailwind and how that becomes relevant to our business is that the DOGE, as well as the administration overall, is focused on taking out fraud through the tax code. They're focused on clarifying the tax code so that the end customer understands how the taxes apply to them. And those are very much in sync with what has been our focus over the years. So that's where I mean it being a tailwind as opposed to a headwind.
All right, Sandeep, we always appreciate you making time for Yahoo Finance, so thanks so much. Again, Intuit stock soaring on the back of those results. As we head to break, we're going to check in on shares of Zoom Info. The company seeing shares jump by the most in 5 years, up 17% on the day. Our own executive editor sat down with the company's CEO following those results. Let's take a listen.
2 quarters ago, I personally bought $13 million of the stock. Last quarter, I bought another $5 million of the stock. Like, I believe in the same thing that the company believes in, is that the price of the stock is undervalued. And as long as it is, there's a great return to be made by buying the ZoomInfo stock. And, you know, I tell investors that I really believe in the future of the company. I know that we're hitting an inflection point where the company is going to really start accelerating.
The IRS is cutting over 6,000 jobs in the middle of tax season as part of a downsizing effort from the Department of Government Efficiency. Several IRS commissioners under Republican and Democratic administrations came together in an op-ed for the New York Times, calling the job cuts, quote, a huge mistake. Joining us now, one of the people behind that op-ed, Daniel Werfel, former commissioner for the IRS from 2023 to 2025. Daniel, great to speak with you here. I just want to kind of level set from you off the top because you were so recently in the IRS. What is your single biggest concern right now about the future of the IRS?
Well, I start with the layoffs, and myself and the other commissioners were confused by this decision, because if the goal is cost efficiency, I think one of the first things you learn on the first day of business school is the bottom line of an organization is made up of both cost and revenue. And the IRS is the accounts receivable department for the US government. And so by depleting the capacity of the accounts receivable of the US government, you deplete the capacity to collect revenue, and you'll actually reduce cost efficiency. So the commissioners got together and really wanted to point out this disconnect between the goal of efficiency and then taking an axe to the accounts receivable of the organization you're trying to make more efficient.
Daniel, what about the ability here for the IRS to even process tax returns, to issue refunds promptly? Is that something that they're capable of doing given the magnitude of the cuts?
Well, this is a concern. And all the commissioners, when we spoke about these layoffs, we all reflected on the fact that one thing you don't want to do during filing season is destabilize the organization. You don't want to increase risk. You want things steady as she goes. And a layoff of this magnitude is going to be highly disruptive. Even if you try to tailor the layoffs more towards collections than taxpayer service and processing, even still, the stress levels that this creates, and also the fact is that as much as you try to avoid laying off people involved in services, there still will inevitably be implications, and we could see delays in processing, delays in people getting their refunds timely. So this is just something that if you're going to make a big move with the IRS, first of all, we wouldn't cut the IRS because that will reduce cost efficiency of the government. But if you're going to make a big move, wait till after the filing season.
Daniel, I'm curious just to get your perspective on this. Given the magnitude of the cuts, there obviously has been a confidence problem when it comes to the American public and their trust in the IRS. After a cut like this, does that actually exacerbate some of the issues that we have seen creep in?
I think there needs to be more education about what the IRS is and is not. Look, the IRS does not do a popular function. Collecting taxes is never going to win you a popularity award. But it is an absolute essential function that someone needs to do. And you know who's doing it? Moms, dads, community volunteers, Little League coaches, people of faith. And the other misconception about the IRS is we're all in DC wearing suits. The reality is that 98% of the IRS workforce works outside of Washington, D.C., in cities, suburban areas, and small towns all across America. And these people just come to work. They're not trying to win a popularity contest. They're doing the job. And here's another misconception. Cutting the IRS does not cut your taxes. Only Congress can decide what the tax rate is. Cutting the IRS just means that the government will be less effective in collecting the taxes that are already owed. You know what? It's the equivalent of a CEO basically saying, we sold a lot of goods and services this year, but let's deplete accounts receivable and make it harder for us to collect the proceeds of those sales. I think the shareholders, the boards of directors would be upset with that decision. The only one that would cheer a decision like that is likely the company's competitors.
Well, and it's interesting in the context of everybody is obviously worried about the deficit, right? And every single organization has inefficiencies that could be cut. But as a former IRS commissioner, where do you see the line between efficiencies and cuts that could undermine tax enforcement?
Yeah, the last thing I want to do is defend the status quo. I've always been a change agent along with a lot of the IRS commissioners that I work with the op-ed on. And we always said we don't have the monopoly on the right ideas, and we always welcome new input. And there is certainly too much waste and error in government. That said, there's been a lot of progress over the years in reducing waste and error. And there's a lot of smart people in the government today that have been working and have saved billions of dollars for taxpayers. Our suggestion is to work with these people, collaborate with them, build on their successes, and provide new input and new ideas on how to accelerate and improve the reduction of things like improper payments or waste in government. But what you don't want to do is undermine the ability of the US government to collect revenue. And the IRS collects virtually all the receipts, $5 trillion a year, that go to the essential functions like air traffic control, food safety, defending the homeland, arming our military. All of that is made possible by a very unpopular thing of tax collections. We should preserve the IRS's ability to collect those taxes and certainly make it more efficient. But laying off thousands of IRS workers in the middle of filing season is not the way to do it.
Daniel, wonderful. We thank you so much for taking the time to join us here on a very important issue. Former Commissioner of the IRS. Thanks so much, Daniel.
My pleasure.
As we head to break, let's take a check on shares of App11. Two short sellers releasing reports on App11, which was 2024's best performing tech stock. Now App11, which provides marketing services to app developers, actually falling to the lowest level that we've seen since November amid its worst intraday drop since 2022. The report's effectively alleging that App11 misrepresents the benefits of its AI advertising platform and instead, quote, force feeds app installations onto phones as a way to drive up revenue. The stock was briefly halted for volatility in today's trading session. You are looking at losses right now of just about 14%. We'll be right back.
Ahead of NVIDIA's fourth quarter earnings report, shares of NVIDIA and ETFs tied to its performance are higher. But our next guest says there's a broader shift away from U.S. equities in favor of assets like gold and international stocks. So could NVIDIA's earnings print be enough to bring enthusiasm back to U.S. large caps? We've got Aniket Lal, CFRA Research Head of ETF Data and Analytics, for this week's ETF report brought to you by Invesco QQQ. Aniket, great to speak with you here. Talk to me about the flows you're seeing heading into NVIDIA earnings and what they can tell us about what we might expect today.
Flows have actually been fairly strong into ETFs this year. We've seen, over $130 billion so far this year into ETFs. A lot of that actually into equity ETFs. So flows have been good into tech. We know historically, though, that flows do tend to lag performance. And as far as performance goes, in the last few weeks, particularly since tariffs were first announced, we've seen non-US equity ETFs outperform US equity ETFs. As you know, this is a reversal from what we saw both in 2024 as well as the period post-election and pre-tariffs. So we've seen some change in sentiment and performance. Flows haven't quite caught up to that yet. Obviously, as you mentioned, NVIDIA earnings is going to be big in terms of seeing how U.S. equities does going forward.
You know, Aniket, that brings up the question, too, just of some of that other risk-off sentiment that has certainly creeped into the markets. And specifically, when you take a look at some of the selling action that we've seen in crypto recently with Bitcoin under a bit of pressure, maybe that hasn't yet been totally or completely reflected within the fund flows data. But I'm curious what you're seeing there, what you think sentiment looks like here as we do look ahead to a potential catalyst here from DC.
What we've seen with crypto as well as the ETFs that track spot crypto is there's really two factors that kind of influence it. One is, of course, regulation, and the second is rates. On regulation, the reason crypto has had such a strong run up in the last 12 to 18 months is really because we've seen a lot of positive news. We saw ETFs being launched in January of last year. That took in over $100 billion. You know, ETFs that track spot crypto now have $125 billion in assets. We, of course, saw the news that Chair Gensler, who's been a little bit more hawkish on crypto, kind of stepping aside, replaced by Paul Atkins. So all of that news, and of course, we've seen recently the SEC kind of dropping its case against Coinbase. And so all of these factors have really been what's driven crypto up. So it's really been a regulatory sentiment-driven appreciation. Having said that, we also know that crypto tends to be very sensitive to rates, and the downturn currently is probably more a reaction to rates. We've seen crypto typically have a very kind of high correlation with tech. And so when rates go up or there's concern about inflation, that really impacts crypto. So it's really regulatory. The news has been positive, but recently I think that's been offset by concern about rates and inflation.
Yeah, and it's interesting, too, in the context of the outperformance we're seeing in European stocks year to date, particularly when compared with U.S. stocks. Talk to me about where you're seeing that rotation when it comes to ETF flows.
One thing interesting about European stocks and ex-U.S. stocks, particularly in Europe, is that the sector composition tends to be very different from the sector composition in the US. As you know, in the US, we've got the Mag 7 and the tech stocks kind of having a huge weight, in the S&P 500. Whereas if you look in Europe, it's financials, it's consumer staples, it's sectors like that have actually dominate a lot of the indices. And we've seen strong results from stocks like Santander, HSBC, some of the healthcare stocks, and Novartis, and so on. And so we've seen actually since the tariffs were first announced in February, ETFs that track European stocks have actually, and developed market stocks outside North America, have actually outperformed US equities, largely on the back of better kind of results from financials, consumer staples, and healthcare.
All right, Aniket, thanks so much for breaking that down for us. Let's do a quick check of the markets. Just about 90 minutes into the trading day. You are looking at some buying action here. The S&P looking at gains here following 4 straight days of declines. You got the NASDAQ up just over 1%, right around the highs of the session. The Dow adding 214. Of course, a move to the upside coming ahead of NVIDIA results after the bell tonight. Very much the direction, maybe sentiment, more so the broader market could hinge on the results that we will be getting from the chip giant here in just a few hours. But again, all three in the major averages. As it stands right now, 90 minutes into the trading day, we are looking at gains. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. We'll see you tomorrow.